back in the saddle. Hi, how's it going? I've missed you all. Lovely, wonderful people. Man, am I out of breath for no good reason. Probably too much vacay. I'm excited for this one. Great to be back live. I will get to the Q&A right after the presentation of the 3 high-growth dividend stocks that I'm buying 2 of them. One of them I do want to add more, but at current moment I've been waiting. And, you know, as we invest and we go forward and it looks like we're going to start hitting some pretty bumpy waters, they're calling for the recession. For those of you, man, let's catch my breath. For those of you that don't know, we are possibly in a recession already. So a recession is when you have 2 quarters of negative GDP growth, I believe. And we've already had one, and it looks like we're going to have a second, maybe a third. I don't know. We don't know where this is going to go. But what we do know is that we can invest in really great companies. And that's what I'm looking to do. What I'm looking to do to weather the storm is just buy these wonderful companies that pay growing dividends. They're solid businesses. And quite honestly, when is it a bad time to not buy? No, how do you say that? When is it? What I'm trying to say is that it's always a good time to buy a good business, a quality company, because they are always going to be quality companies until they're no longer quality companies. Hello, Enron. So with that being said, thank you all for joining again. And let's pop on the screen and we will see what the first one is here. By the way, I didn't find any hotkeys for this, so we're hopefully not going to have the same mistake that we had before. With the Tootsie Roll incident, where I was sharing Tootsie Roll as the company that has split their stock for 51 straight years. Every year they do a 103 basically to 103 to 100 split, or it's 1.03 to 1, I think is what it works out to be. So if you have 100 shares of Tootsie Roll, you get 103 shares. So you can see on the screen here, the first one. Let's go full screen. Now let's leave it like that. You can see my tabs up there. Now let's do it. Let's hide it. It's like, what's this guy doing? I don't know. There we go. Here we go. And I think I'm still on. Oh my God. This is what you get here, people. This is what you get. I don't know if can you all still see me? Somebody give me a wave, give me a thumbs up. Are we still going? I put airplane mode on. This is what you get here. I think we're still live. We're still good. Yeah, thumbs up. All right, here we go. Let's try this again. Not doing airplane mode. I think it was, I don't know. Anyway, first one, Honeywell. This turns into a shit show. First one is Honeywell. Check it out. Dividend safety score of 99. And they have had really good long-term dividend growth, as we'll see in a second here. But Honeywell, for those of you that don't know, they make thermostats. They are really all over the place. They have parts on the James Webb Space Telescope. They have obviously the flight safety systems. They are in military components, aircraft controls. I mean, they are just almost as diverse as 3M. Quantum computing, they have one of the world's fastest quantum computers, although I think IBM holds the title with their Eagle. I do have 9 shares, so I really should bump that up to 10, because why not? But let's check it out. A little bit about Honeywell here. Their last dividend growth was 5.4%. Now that's traditionally beaten and paced inflation. The last 5 years, though, 9% dividend growth, which is awesome. And 8% CAGR for the last 20 years. That's pretty much beating the pants off of inflation as then. Now we have 8.4, 8.1% inflation. That's not going to be here forever. As I go ahead and put myself on YouTube, which I should do because I'm still new to this thing and I can't tell I can't tell what the heck. Let me get that set up. Cheers, by the way, to all of you here in the United States, and they're going to be celebrating the Independence Day holiday. So you can see Honeywell has had 11 years of dividend growth, and they've had 29 years of uninterrupted dividends. We can see they're paying $3.92 per share. And this is just really solid because check it out. Hold on. Uno momento. All right, there we are. Good. I'm on. I'm working. We're working, Ma. We're working. We got it up. The guy turned airplane mode on and shut everything off for a second. Anyway, their 5-year dividend yield is 1.99%. So we're at 2.24, which is 12% above the 5-year average. Their PE, so this is kind of like the sweet spot we want to look for, is when the dividend yield that's current is above the 5-year average and when the PE is below the 5-year average. That's a really good starting point for something that's, on sale. So Honeywell at the lower end of the 52-week price range, $175.11. It had been as high as $234. And that PE, though, is still a little bit above the industrial sector. So some people like to wait for that to come below the sector. One of the best things you can do is always compare the price to earnings ratio, which is, by the way, 19.4, means you're paying $19.40 for every $1 of Honeywell's current earnings. And the industrial sector is at 15.9. So it's always good to compare the PE to the company's historical PE and to the sector's PE. Like, it doesn't make sense to compare Honeywell to Coca-Cola's PE, two completely different companies. And just a couple quick metrics we'll run through. I don't want these to be too long. Some of the more important ones, the free cash flow payout ratio currently at 62%. I want to keep an eye on that because, as you can see, Simply Safe Dividends, which is the site we're using, prefers below 60%. And since 2020, they've been ticking up 48%, 51, now 62%. So I'd like to see that coming back. But honestly, I'm pretty comfortable with anything below 70%. It's when we get above 70% that we start getting into what could be a little bit of red flag territory. Their free cash flow per share has been dipping a little bit, currently at $6.15. So we want to see that coming back up. Obviously, earnings per share has been going up, and earnings per share is a little bit skewed sometimes because they're buying back shares, which means there's less shares to spread the earnings out over. So that can be a little bit financially engineered. So free cash flow per share and free cash flow payout ratio, I always like to look at over the EPS per share and payout ratio. Sales growth has been steady. They dropped in 19 and 20, so that's not very good. So we're happy to see that up, and we want to hopefully see that trending above, 0%, I guess, as a starting point. Shares outstanding, Honeywell is at 697. They've been buying back shares pretty consistently. Sales, this I don't like to see, has been down a little bit since 2018, and it's kind of chopped sideways. Currently at $34.3 billion, but you see in 2018 they're at 41.8. So hopefully that will start coming back up. I like to say that from what I've been looking at, when we're investing for companies that should be able to weather recessions, you want really high return on invested capital. This is 17% for Honeywell, so that's good. High return on equity, 28%. Good free cash flow margin at 12%. And they have a little bit of debt, 36%. So that's still below what Simply Safe Dividends likes to see at 40%. But again, regardless of how much debt a company has, the interest coverage ratio on here, I'm hoping you guys can see this okay. Maybe I'll make it a little bit bigger here. The interest, too big. The interest coverage ratio is at $20.35, 20.35. That means that they have $20.35 of operating income to cover every $1 of interest expense. So obviously when rates tick higher, if they hit some speed bumps and start losing some of that operating income, they're still going to be able to cover the interest on the debt. Because if a company can't cover the interest on the debt, then you start getting into default, and that's no bueno. So that's the first one, is Honeywell. You can already see my next two here. I don't care. Whatever. Information's still good. Second one, this one I have been buying in our Roth. I think it's the Roth. We'll see in a second. Is Lowe's. Most people know Lowe's. They're the hardware store. Super high dividend growth with their last one, 31%. The dividend yield is currently 2.37%. Dividend safety score of 93, so very safe according to Simply Safe Dividends, which means there is a very low likelihood of a dividend cut or reduction, which I guess is the same thing, right? Cut and reduction. I have 4 shares currently. This is a newer position for us as well. And let's see here. Yeah, so they don't have a meaningful amount of debt, which is good. And you'll see they do have a low payout ratio. But check out the dividend growth for Lowe's. Dude, 31% in May of 22. The 5-year CAGR, 18%. And the 20-year CAGR is 24%. They have a 59-year dividend growth streak. So they're a dividend king, which you need 50 years of dividend growth to be a dividend king. And yeah, it's just super, super solid, really fast company that grows the dividends. And yeah, it was below 2%, I believe, when I started buying. But this is what I'm looking for, is companies that are going to compound those dividends and really, really start to grow them fast, because you get in on the bottom floor and you really start moving up quick with your yield on cost. Currently $4.20 a year. And just check that out. In February of 2020 or May of 2021, it was at 60 cents. Then it jumped to 80 cents per share per quarter. Now we're at $1.05. Fantastic. And here we go. Remember what I was just saying, wanting companies when the 5-year dividend yield is above and the PE is below. We'll check that out. The current yield is 32% above the 5-year average. And the forward PE of 12.8 is below the 17.9. So you're paying $12.80 for every $1 of Lowe's earnings. And again, still at the low end of the 52-week range, which went as high as $261.38. Currently at $177.36 right now. And look at that, man. With the consumer discretionary sector, they are almost exactly in line, a shade higher, 12.8 versus 12.3. And they have really solid numbers. Check it out. Free cash flow payout ratio, only 32%. That is just stupidly low. The free cash flow per share, $10.10, which is just solid. Now it's tick back a little bit. We see that they obviously, with all the stimulus and people being stuck at home and just putting work into their houses, it was as high as $12.40, which is just monster, double off of 2019 there. I think double, almost double, about double. And yeah, earnings per share has been going up. But remember what we said, we want to see companies that have free cash flow per share growing and the hopefully sales growing as well, which this, it's been better. But I mean, that was such an anomaly, that 24% sales growth from 20 to 21. And we're back down to 1% now. So it looks cyclical to me. And I think they're going to be okay in the long run. They've been buying back shares quite heavily, already down to 685 million shares outstanding. And this is something that's a thing of beauty. I love seeing is the shares outstanding just dropping, but the total sales is rising. So currently at $95.5 billion the last 12 months. And just a sky-high return on invested capital. Now, the return on equity is negative 263%. That's something that you would have to look a little bit into. And if anybody knows why it is so low, I currently do not. I would love for you to share with all of us in the community. But free cash flow margin has been dropping down to 7%. So not perfect, but I still like them. They show not a meaningful amount of debt, but again, this is why we have to do our own due diligence. I'm not going to go deep into this. And it looks to me like they may be missing something there, because I don't think they went from 94% down to 0. But with the interest on the debt, they can cover it. $13.27 of operating income to cover every $1 of interest expense. And the last one, this is one that I just did buy when we were on vacation in the Ozarks, was Snap-on, ticker SNA. 2.87% dividend yield, a dividend safety score of 99. Wonderful, $10.6 billion market cap. Big company. Not a lot of people are that familiar with Snap-on. They're in my wheelhouse. I do work with tools. I'm in the trades. I have 4 shares, and I'm really starting to build this up. And I'm probably going to just keep buying while they're down low. Let's get to a few interesting metrics here. 12 years dividend growth streak, 29 of uninterrupted dividends. Check out that last growth dividend increase, 15%, the 5-year CAGR, 15%, and the 20-year CAGR, 9%. So just really fast, really solid dividend growth over the last, the last 5 and the last 20, just really solid, really nice annual dividend per share chart right there. $5.68 per year currently, and it looks like in December. So around December, they should be due for another increase, and I'll be really curious to see what that is. And remember, when you buy here, you're locking in that current yield, and it's just going to get bigger the higher and faster that they grow that and increase that. And here we are again. This is why I picked Snap-on. The 5-year dividend yield is currently 20% above the 5-year average. So the current is 20% above the 5-year. I think Motor Mouth over here is trying to say. The forward PE ratio is 12.3, which is below the 13.9. Really, really at the low end, like most of these, of the 52-week range. It went as high as $231 a share, currently at $198. And I think it was last week, it was $191 it hit. And they are below the industrial sector PE at 15.9. That's the average. So currently paying $12.30 for every $1 of Snap-on's earnings. And look at some of these numbers, just solid. The free cash flow payout ratio, only 37%. And you can see they kind of ping pong between 29 and between the high 20s and the mid to high 30s. So just completely in line with what they've been paying out. Free cash flow per share has been dropping just a little bit. Earnings per share, remember we said that can be a little bit financially engineered or manipulated by share buybacks, but that has been going up and to the right. But you see, I love that when we can look at this, that the earnings per share number and the free cash flow per share number tell a very different story. Sometimes. Sales growth was really nice coming out of the pandemic. It's been dropping just a little bit with everyone, going back to work. And here it is. The shares outstanding it was flat, increasing just a tiny bit in 16, but they've been buying back down to 54 million shares. That's not a lot. And the total sales, 4.67 billion. So we see the total sales has been largely increasing with that dip in the COVID pandemic. Again, want really good return on invested capital, return on equity, which they have both of these, well above what they like to see on Simply Safe dividends. The free cash flow margin been dropping just a little bit. Operating margin going up and to the right. So most nice. And I did look at this. They have very, very little debt. I did verify this one with Snap-on. So just a solid company. And the little bit of debt that they do have, they have $23.28 of what? Operating income to cover every $1 of interest expense. And before I get to all your wonderful people's Q&As, which I love to see that you guys are firing questions, I wanted to show you some of my worst holdings because why not? I'm still holding. Let's see here. Gain or loss, that's what we want. Look at that. ExxonMobil. So those of you that have been with me for a while, you remember I was extolling the virtues of ExxonMobil, saying this is why this is a great time. I don't think they're going anywhere. It's going to be years before EV completely takes over, and they're never going to go away. They might become like one of the tobacco companies in that sector, not really growing as much, just maintaining and paying those fat dividends. But here we go. I think I have a couple penny stocks I've been playing around with. Remember, I don't play the lottery. I still don't know why I buy these. Voyager Digital, they've been in free fall. They have one of the companies they lend to, I think, is defaulting. Anyway, I tried to get cute. I bought 100 shares when it was at 65 cents. The Charles Schwab, because they're an OTC company, charged me $6.95, and they promptly fell down to 30 cents. So I'm underwater on that. But of the big ones here that I want to buy more is IIPR. They are the company, the cannabis. They own like the grow facilities that cannabis producers and growers use. I'm 34% down on them. But two of the big ones here I wanted to point out was 3M. Now, they have a lot of litigation. I was going to say liquidation. They have a lot of litigation that we have to watch, and kind of in a holding pattern because I want to see how some of this plays out. They're again at 52-week lows. And man, we got to watch out for these bellwether trials. And if they go to full trials, they have an earplug issue. There's a company they acquired, and they were defective. They made earplugs that the military bought that ended up being defected. Some of them were misused. A bunch of Army, I think it was, they have tinnitus and hearing issues. So there's lawsuits going on, and it could be pretty expensive. But I think they're going to keep increasing the dividend like 1 penny per share per year instead of those big increases until this is all sorted out, which could take years. So 3M is going to be, I think, down for quite some time. But Intel is another one. Look at this. You'll remember I sold a covered call on Altria. They got called away, and instead I bought Intel at $47 a share. I wrote a cash secured put, kind of got cute. It got assigned to me. I have 100 shares at $47. Well, I had 26 on top of that also, but I'm down 23% on my Intel. So that's well over $1,000 I'm down. And you know what? I still think they're good. Simply Safe Dividends gives them a safety score of 80. I think the whole sector, I saw that Micron, NVIDIA, a bunch of the other chip companies are pretty far down, and it's just, they're getting hit. The CHIPS bill, I think, is going to pass eventually, which is going to put a whole bunch of capital into companies like Intel. They're building. They have a really interesting story, but right now we're kind of paying for the story. So I'm buying into what Pat Gelsinger is doing, and I am holding Intel. So that is that. We're going to stop sharing the screen. I'm going to say hello to all you people. I've been motor mouthing for 22 minutes. So I am so excited that you guys are here. And hey, what's up? So if you like it, let me know if you like that, where I kind of have like an idea for a video. There's a concept to get you guys in and get you just some information to start off. And then right now we can chat. And for those of you that are watching this 2 weeks, 3 weeks from now, I'm going to leave it up. I cut out the last few, but there may be words of wisdom, things we can look up here, and things we can do. So hello, everybody. Oh, let me put the chat overlay on since we're here now. We're over here now. All right, good. I'm on. So yeah, what I did, I was trying to go to the full screen button, and I don't remember where that is. And I hit airplane mode. That's the beauty of this. So I don't know what happened, but yeah. All right. What do you guys, so what are you buying? What are you doing for the holiday here? You don't celebrate this in other countries, but most of you, I think, are in the United States and Canada, our brothers to the north. Yeah, I clicked the, let's see what we got. BlackRock, Citizen of the Year. I guess you're saying you're buying BlackRock, huh? I like it. Darth, my guy Darth, dude, this guy is one of the hardest working YouTubers I know, constantly pumping out content. He's going to school. I believe you work full-time, Darth. Just check out the man's channel. The guy is a machine. I'm a machine. Yeah, happy 4th. Happy Independence Day, everybody. Let's see. I like this one. Aramco stock. Oil price is skyrocketing. Yeah, that's an interesting one, right? I know a lot of people don't want to invest in Aramco because they're Saudi Arabian and they have issues with human rights. But I don't remember. Does anyone know where you can buy Aramco? I think they're actually OTC maybe. Or no, we have to buy them on the London Stock Exchange, maybe. I don't know. Does anybody have an answer for Aramco? Let me know. There he is, Ryan Williams checking in. This is awesome. What's up, Ryan? Yeah, man. Snap-on is a beast. So actually, Ryan turned me on to Snap-on. Watching the man's videos got me interested. And I've been thinking, like, I see Snap-on all over the place in my industry. I work in the commercial loading dock equipment. I do welding. I'm primarily a welder, service tech, and it makes sense. And I looked into the company, and I couldn't believe what I had been missing. Oh, no. Let's see. We'll let them chat about that. Let's see. I saw Snap-on fixes delivery trucks for Aristocrat Company. What do you mean, Sunbreeze? You Snap-on, they were fixing delivery trucks? Who's that? Pepsi they were fixing? Let us know. Let us know. You know, hold on. If Darth, if you're still on, what is that? You had another yield trap chase me at a bar. I don't know what that means, but now I'm intrigued. You can't open up a loop like that. You got to fill us in real quick. Yeah, here. Yeah, we'll do a video together soon with these guys. I'd love that. If anybody wants me to look up anything on Simply Safe Dividends, just really quick, give a really quick opinion. Let me see about it. Yeah, here we go. Clowning around. The man has been with us for quite some time. 3M looks like a solid long-term play. 3% yield while you wait. Yeah, I haven't been adding. I'm so tempted to add more 3M, and I think they're going to be okay. I don't know. What was the one vet paid? Like $70 million, I think. If anyone corrects me on that, I think one of the recent bellwether trials that ended, the veteran was awarded $70 million, which to me is nuts for hearing loss. And I'm a veteran, and I know that I don't remember what the exact number was, but for KIA for a serviceman killed in action, I think it's several $100,000 that the family gets. So it just doesn't seem right that you'd get $70 million for some hearing loss when people are getting pennies for losing their loved ones. But you know what? It's what we sign up for. It's so unfortunate. And we sign that contract when we go into the military and we put our lives on the line, and we're willing to. That's the whole point. You are basically government property at that point. But there is the contractor defense that I know 3M was trying to use, meaning that saying they did everything to the government specifications and the government signed off and accepted everything that they wanted them to do is okay. They made them aware of some of the potential fitting issues, and then this happens and you get the lawsuit. So, but this is what the courts are for, and we will have to see what, let's see here. Here we go. Steven, he was in Iraq 07, BS. I did not know you were in the Navy, Steven. What were you? Yeah, I think a lot of it was right. They didn't fit some people, and they were supposed to fold them over a certain way, and they didn't do it right because the government wanted their own instructions, I think is something. Yeah, that's interesting, man. Well, salute to another military veteran, especially Navy veteran. By the way, this, there he is. I'm going to get rid of Ben Franklin. I've been looking at some, I think bigcanvas.com has just really nice canvas pictures. And I found one of the boat I was on, the USS John C. Stennis, CVN 74. And also, little inside baseball, I have autofocus on my Canon camera. And there's a lot of times that it'll start focusing in on this guy's face right here. And I go blurry because it thinks he's a person. So, yeah. Here we'll. So Stephen was a CB. CB is construction battalion. CB meaning that they do, guess it, construction. So glad to have you aboard, shipmate. I love it. Yeah. And by the way, I was a machinist mate, third class. I was an MM3, and I worked on weapons elevators. And let's see. Here we go. Question: would you still buy more Intel even though they're laying off people? Yeah. I haven't, but man, I want to be completely honest, but I have those 100 shares that I kind of didn't intend on getting stuck with. I thought maybe, so my plan was to sell the cash secured put at 47. And then the next week I wanted to sell another for 47, a covered call, and figured I'd get out, but it just kept going down and I've been holding the shares. So, you know, you've heard me say I'm comfortable holding those shares and just getting paid the dividend, but I might add a couple more, but I'm kind of saturated with them now, I feel, and looking at adding and building up Snap-on and Lowe's, I'd really like to. But if anybody has not invested in Intel yet, I think Intel is just, again, I'm buying what Pat Gelsinger is selling, and I think this would be a great, great place to begin a position in Intel. Not financial advice, but yeah, I think they're a good company. What's up, Rick? Rick Gilbert, hello. Good. He likes to look at the 3 stocks. So yeah, maybe that went on a little too long. I have my hiccups that I'm still ironing out, but whatever it is, I love to do that because I'm kind of thinking of people in the future. I don't want to just start something, just this. I really enjoy this, is hanging out with you guys, hearing what you're doing, looking up stocks, chatting, but that I don't think plays really well for the replays. So for all those future people, I just kind of want to go right into the content, give my ideas. Went a little long, and then we'll do that. So, or do this. And yeah, I'm going to watch fireworks tonight in Naperville. My old brother-in-law's not old. I'm older than him, but yeah, nice. Love it. I love you guys watching everybody's channels, man. It's just a big community here. Yeah, dividend happy hour. That would be fun. I would love that. The Money Man, Suzuki. Let's see. Hey, Caitlin's on. All right. I bought Pepsi for the barbecue later, and I thought of you. Well, hey, and we appreciate you. And my one daughter, she has a little bit of Pepsi. And yeah, it's a silly video I did. I know I said I was going to do a live stream, but I was on vacation with 10 other people, or no, 9 other people. I was the 10th person. And it was just, man, it was just too busy. We were having fun. I did a script for the next video. I'd spent like 2 hours total the whole trip doing that. So, hey, you know what? We got to live life off the spreadsheet. You know what I mean? We're investing, we're buying these stocks, but man, like I have 2 daughters. They are 15 and 14, or 14 and 13. They're one of those 2. They're 15 months apart. And, they were, I don't know, they didn't want me to do any more work. They're like, come do this. So we did it, and it's, yeah, it's life. You got to live it, people, because the damn thing is short. It's later than you think. Have fun. Trust me. And, all right, what do you got here? But anyway, thank you, Caitlin. I love that. And yeah, I'm still not going to buy PepsiCo. They're 13% of the portfolio. So I'm kind of waiting. Here we go. Yeah. On FAM, right? I was in the Navy with somebody with the last name FAM. So I believe that's Filipino, I believe, right? Yeah, what are you looking at? Intel, T-Row, and WBA. Yeah, so T-Row price looks really solid. I know they have a really good score. Walgreens, again, not sure what they get on a Simply Safe Dividends. You know what? Let's look it in. Let me pull up my window again here, and then I'll share the screen. All right, here we go. Let me pop that on. Share. So Walgreens, here we go. 79 safety score. You know what? I kind of lost track of Walgreens. I didn't realize that if I can make this a little bigger. I didn't realize that the yield was almost 5%, which looks really, really slow dividend growth. Let's see how high above the 5-year that is. November of 2020, Amazon reaffirmed, I'm sorry, I'm looking at this. I'm looking at my phone, thinking what I want to say. Simply Safe Dividends reaffirmed their score as safe. But let's see. Hey, look at that. During the last recession, Walgreens actually increased their sales 5.6%. 46 years dividend growth. The last one, that's interesting, 2.1%, but a 5-year CAGR of 5% and a 14% 20-year CAGR. Let me look at a few numbers. Paying $1.91 a year. And the current yield is 45% above the 5-year average, which is pretty healthy, right? 3.43%. And the current PE, 8.4, which is below their 5-year. So, hey, this looks really interesting. I mean, we go to Walgreens, right? Everybody here in the U.S. uses Walgreens for the most part. They are at the low end of the 52-week range. And so, see, Simply Safe Dividends, it's interesting. They give their opinion. So they put the free cash flow payout ratio bar at below 40%. But honestly, they're only at 48% free cash flow payout ratio. I think below 60, below 70, that's kind of like the higher end. So I think that is really nice. Free cash flow per share been dropping a little. Won't get too boring here. Looks like they are still buying back shares, down to 866 million. Total sales have been increasing. They're currently at 135 billion. But this kind of actually makes me a little concerned that return on invested capital is only 4%. That's pretty low. So free cash flow margin 6%. That looks nice, but a little bit of debt, 52%, and a kind of low interest coverage ratio. So I don't know. That's interesting. I don't think Walgreens is going anywhere. Is anybody else buying Walgreens? I'd like to know. Meow. Love it, meow. You can buy a Ramco. Oh, Saudi ETF. Yeah, man, that's we're missing a lot about this recession inflation created by high oil price. Yeah, I don't know if that was the sole driver of it, but yeah, that'd be interesting. Does anybody else own a Saudi Aramco or have any issues owning them? I'd like to hear that. Sunbreeze, Coca-Cola, good company. Warren Buffett still likes it. Here, what we got, meow? Instead of us ranting about the price of skyrocketing, we should adapt. Take some pie of the money of those who selling oil for a living. Yeah, honestly, I don't know if I would agree with that. If I'm not exactly sure if you're just like talking about higher wealth tax or something, but yeah, I don't know. I know different countries tax wealth and income differently. And let me see here. Darth, strong IPA in my hand. Yeah, buddy. If you're still on, what kind of IPA? I don't know the last one I drank. Artesian, Two Brothers. I think they're here in the U.S. They're in Illinois. Here we go, man. Wyatt Abbott, Franklin Templeton, BEN. I think Ryan just covered Franklin Templeton, maybe. Somebody did. I was watching. Let's see. Darth. JXN is new for me. Is that I won't put it up, but that's one I'm not terribly familiar with. Jackson Financial, 8.14%. And interesting. New company, right? Looks like they've only been around for a little bit. Yeah, Steve was a CB. I love it, guys. I got to catch up here. Beautiful. Steven agreed on Intel. What else we got here? Rick's been buying BEN, Franklin Templeton as well. Let me plug them in for my own. I'll tell you what their safety score is. So what are you guys all doing today? What's your plan? You going to watch fireworks somewhere? 70. That's safe with a dividend yield of 4.92% for ticker BEN, which is way above their 5-year average. Nice. Oh, here we go. Please have a video about my dividend picks. Apple, Saudi Aramco, McDonald's. I don't know if I can jam them all in there, but yeah, Saudi Aramco. I'm going to have to look into that. I think aren't they the largest company in the world, the largest publicly traded company by market cap, I think. I think they took that title from Apple, right? Not too long ago. Microsoft, I think Microsoft is one of the most solid companies on the market. And Coca-Cola, Nike. Yeah, Nike, actually, I have them on my watch list. Dude, there's so many companies that I want to own. And I'm just kind of glad that really quickly, what I share here on the board is things I've been investing in since I started the channel, doing this journey along with you guys. But the biggest chunk is in the IRA, and that's through my work. And currently we're at 30% of our pre-tax dollars go into that. So we max that out. And then whatever I have left over, I'm investing over here into YADA, into an emergency fund, into a travel fund. and putting money away for our kids' wedding. Dude, we save a lot, and I probably should have a budget, like a spreadsheet, which we should. Do you have a budget? Do you have a spreadsheet? And if you do, where do you use it? Nice. Darth loves Ben. Yeah, that's one I'm not very familiar with. Here we go. Let's see. Really hope all Dapper Dividend videos will end with you jumping into a lake. Oh, dude. Well, it could be hard because I'm here in Chicago. So February, that might be a little bit tough, but hey, I liked it. It was fun. It was the shore bell, Spike Mountain. How was it? Yeah, it was sugar-free, which to me, zero sugar stuff because of the chemicals. The chemical sweeteners has a little bit of a funky taste to it. So it didn't taste quite right. And I get it. But for people that can't have sugar, that's a good alternative. But some of the other stuff has too much sugar. I try to stay away from a lot of sugar. So, but it was a special occasion and it served its purpose. Here we go. Anybody watching, check it out. Darth has Ben, H-band, I don't remember H-band, RF, Key are all at a discount right now. So mark those down for you guys to look at later. Dude, thank you for sharing those. Thank you. Let's see. I just answered that. What am I doing? Dude, I am so sorry for saying that you're Filipino, but Vietnamese, I guess that sounds right. I don't know. It's so silly for me because I've never been over in that region of the world, and that's just my American guess. So, hey, at least I was kind of close, right? I mean, it's Asia, or that's considered Asia over there. So, yeah, thank you for watching. I appreciate that, and I apologize for saying you were Filipino, or at least I said right. Caitlin, if you want an interesting contrarian dividend play, I would suggest looking into FRG, retail holding company. So they're facing a lot of headwinds, but have crazy upside at current price. All right, I'm intrigued. Let's. I want to take a peek at FRG. I want to see what they get. I have never heard of FRG. Franchise group. No rating. So they're a small cap, 1.31 billion. Move that over a little bit. 7.70% dividend yield. Okay. Oh man, 56% dividend growth as of late. We won't read all this. Operates Vitamin Shop, Pet Supplies Plus. Oh, okay. Badcock American Freight, Buddies, and so I definitely know Vitamin Shop, and Pet Supplies Plus. So I definitely see those. Interesting. Very interesting. This is not interesting that they had, it looks like they might have started paying a dividend in, they don't tell, potentially 2015. And they flat cut, and now they're skyrocketing it up. So I don't think that's sustainable, just from what I've seen. It may be, just my opinion. $2.50 per share annually. Free cash flow payout ratio, 174%. But are they a bank? No, general merchandise store. Yeah, that, I don't know, man. That makes me really, really nervous. 174%. And I'm betting they're having a bit of debt because that has to be coming from somewhere. So they're paying that dividend from something, either through share dilution or debt or both. Free cash flow per share has been dipping. Sales growth, I mean, that was nutty. 900% for the COVID era now. So they might have had that influx of cash and just decided to pay a super high dividend. Yeah, here we go. Shares outstanding in 2013, 14 million. Now we're at 41. So look at that. 19, it was 13.8 million. Now we're at 41.2 million. So they've been really, really diluting shareholders. But I will say that their sales have been increasing. So that's good. 10% return on invested capital, high return on equity. And yeah, they got a bit of debt that's been slowly increasing. And a very low interest coverage ratio. It looks interesting, even though I know those stores, it wouldn't be for me. Yeah, that's just a little bit too much debt. I wouldn't be into that. But hey, I'm curious. let us know. I mean, let us know if I'm wrong, how it goes. I guess I'm saying I don't have a high level of confidence in some of the things that I saw just from that very quick looking at of FRG. Let's see. Joe Podgorski, another ski. Fun fact, everybody, get ready, but Knopf is not my name, my birth name. Those of you that know me, my mom remarried when I was 9, and I took my stepdad's name, who I'm now estranged from. It's kind of like a bad tattoo because I've gone through high school, the military. Now, I've been married and have kids. Anyway, it's too late now, but Malcheski was my birth name, SKI. So I too am, no, we call it within term of endearment. I'm a Polak, so I can say I'm a Polak too. So proud Polak. Those are a lot of people I grew up with in the Berwyn Cicero area. H-Ban, only bank I've never had a problem with. Very interesting. Is that Huntington? Let me see. Huntington Bank Shares. 50 borderline safe, 5% yield. Yeah, you know what? And that's cool. That's very Peter Lynch of you, right? You've never had a problem with them. So don't just go and buy companies that you use. You got to look into them, because look at that. Like, what if I said, I love Pet Supplies Plus? And I could be wrong, but if I shop at Pet Supplies Plus and I love Pet Supplies Plus, and then I've just bought shares in their parent, it doesn't look too good to me, but I could be wrong 100%. And I think that goes without saying. Put Walgreens in your daughter's account, Rick. Longer time from them. Yeah, I don't think they're going anywhere. I remember there was some talk, oh God, maybe 2019-ish, right? About them being bought out or being merged, or there was something I kind of remember somewhere in the back recesses of my mind. But yeah, I think they're going to be good for quite some time. Folt looks pretty good in the smaller financial services sector. All right, well, let's take a look at Folt. Let me need to come up with a thing I'm going to go to the screen share now. Let's see. Fulton Financial, no rating. So just the no rating means they're not covered. It means they don't have any coverage from, I think Simply Safe Dividends covers like 980, 911, somewhere between 900 and 990 stocks they have coverage on. And again, there's just, 3,000, 229, I don't know. It's somewhere around 3,000 publicly traded companies, but we still get the numbers here. They, wherever they scrape these from. They're 8%. Yeah, so they've big cut during the last financial crisis, but they've been pretty much raising ever since. 60 cents a share. Now they're a bank, so that free cash flow payout ratio, it looks that looks stupidly high, but I was going to say some of them banks are a little bit different. You can't use the same metrics for like a PepsiCo, but yeah, you'd still want to see better free cash flow per share than 8 cents. They still need sales coming in. They're down to 163 million shares, and sales, total sales don't look too bad. Yeah, and the whole return on invested capital and net debt and whatnot, because they're a bank, so it doesn't always apply. But I don't know enough about them, and I would have to really dig into FULT. And yeah, I don't know. For me, again, that's just another one. If I don't feel comfortable, I'm not going to invest. And obviously, I felt really comfortable holding Intel at $47. Now we're down to 30, whatever it was, 36-ish. So yeah. What else do we got? Let's see. What is that? No, Steven, did you tip me $5, man? Oh my God. I got to have some kind of super sound or something for this. I don't know. Do a handstand or something, dude. Wow. I'm impressed, man. That is the first super chat I've gotten. Man, cheers. Thank you, brother. Thank you so very much. I really do appreciate that. Ask me whatever you want, man. My favorite stock. So my favorite stock, it's kind of shifted, right? So for a long time, it was Johnson & Johnson. But And they're still up there. They're probably number two. They probably flipped with PepsiCo just because there's a little bit to me of uncertainty, which I'm not sure how it's going to play out with them splitting into two companies. So they're, if those of you that don't know, in 2023, I think the end of 2023, Johnson & Johnson plans to split off the consumer health, which is like Listerine, Band-Aid, Neosporin, all the beauty products, anything you're going to find in a Walgreens except for the pharmaceuticals. So anything not in the behind the counter, you're going to find that's the consumer health stuff for Johnson & Johnson. They're going to split that off into its own company, and anybody that wants to invest in that can invest in that and target that, and it'll give that company just to focus on growing that, which is why they'll call it unlocking value. And then they are going to have the pharmaceuticals and the medical devices. So obviously all the drugs like the Remvolid, the Stelara, all those coupled with the medical devices. So all the stuff that the doctors use in the hospitals, that's going to be its own company. So they're splitting off into two companies. And I think it was almost 80%-ish of their revenue was from pharmaceutical and medical devices. And my number's a little off. Maybe it was 14% was from the consumer health. So consumer health, as the company is now, is not a core segment. So they're just splitting that off by itself. And, you know, it's kind of interesting. I think that the consumer health is not going to grow as much, but it's more stable. But the pharmaceuticals have way, way higher upside. So I'd love to say Johnson & Johnson is, but that little bit of uncertainty to me, just because I don't know exactly how the company is going to, how it's going to look. They still say they're going to be the number one, I believe, healthcare company as a standalone in the world. So just solid. I think they're great. And I'm going to say PepsiCo right now, just because I understand it so much better. And I see all their products that they keep trying to innovate, like I just did with the hard Mountain Dew. Man, I think that PepsiCo is just going to be just like they are. They're just going to keep pumping out food and drink and trying to get healthier and adapt and shift. And as I always say, these companies are living, breathing entities, and we get to watch them evolve and adapt right before our eyes. And I know PepsiCo is trying to use less saturated fat, less sodium, less sugar. They're trying to be a little bit more health conscious. Why? Because the consumer is demanding that things be a little bit more health conscious. So, you know, if I had to look at the two, it's really close, but I'm just going to say my favorite stock is PepsiCo. That was a really long way to get to that. And brother, thank you so much for that tip. Like that means the world to me. I really do appreciate it. And I don't have any bells or whistles or anything set up for that. So thank you so much. I do appreciate that. And SNC, you're welcome, man. And again, these are just my opinions. This is just my opinions as an enthusiast, as an amateur, as somebody that spends way too much free time looking at dividend stocks and the stock market and listening and reading all that I can. So just my opinion. Always do take this opinion with a grain of salt. And I love it here. Let's see. Okay, there's Caitlin said there's a lot of bad looking data on FRG because they were, I did not know. See? Goes to show, I didn't know they were Liberty Tax. Were bought and transformed under new leadership in 2019 into FRG. But I'll update you in 6 months on how it's doing. Please do. I'm not going anywhere. I hope you don't go anywhere. And if you're invested in it, God, I hope I'm wrong. I want everyone to do well. I just want people to make money, to be able to live more free. Because, right, like I say that I'm teaching my kids that money is not the tool. No, son of a gun. Money is the tool. Money's the tool. It's not the ends. And all that money does is it allows you more options. People with more money have more options. But just like the tools I work with, those tools can't bring me happiness, but I can use them to build things to bring me happiness. So always remember that money is not the ends. Money, in my opinion, is just a tool. That's all that it is. And it allows you more options than those without money. That's it. So What's my opinion on Stag and UGI? Well, so Stag I still own. We can pull them up in a second, but Stag has been down. I know that. UGI I covered a little bit. Funny story, they're AmeriGas. Nobody cared, but when we went to Walmart in Camdenton, Missouri, where I got the hard Mountain Dew, they had an AmeriGas, which is propane outside. So UGI owns AmeriGas, and here, I'll pull them both up. Mr. Fan. Here we go. I'll share. Actually, let me share my screen first. So let's look up Stag for single tenant acquisition. I know I said that they stood for me, super tall, athletic guy, was Stag. Now it's a single tenant acquisition group. By the way, I am 6'4", so kind of goes along with that. But yeah, borderline safe. So this is one that I have 10 shares, yield on cost 3.79, which is below the 4.64. So kind of interesting. I could buy shares and start pulling up my yield on cost. Let's see. They reaffirmed them in May of 2022. They reaffirmed their borderline safe rating. That's, by the way, this is kind of cool. What Simply Safe Dividends does is they will reaffirm, and every time they look like they followed their Q1 earnings release, and then they said, yeah, we're sticking with everything the same, the rating we gave them. So you get to know when the last time was that they did that. But they're a REIT, so it means they have to pay out, oh my God, I forgot, 90% or 80%. I don't know why I'm having a brain cramp here of their earnings. I think it's 90%, right? I don't know why. I just can't think of this right now. Very slow dividend growth as of late. Not been growing it a lot. Very good 10-year, but it's because of this big jump the first couple of years. They're a newer company. They first started paying it. 10 years dividend growth. They do pay every month. That's right. September, October, November. So they're a monthly dividend company, kind of like Realty Income, paying $1.46 annually. And we do see that the current dividend yield is below the 5-year average, and the PE is about in line. Yeah, at the low end of the 52-week range, but high free cash flow payout ratios, which is why I think they give them that borderline safe. But with REITs, we always have to look at the adjusted funds from operations per share. So, which is what they have there, right? No, they have free cash flow. Here, the adjusted FFO payout ratio. So this is more in line. You see 128% of the free cash book, but they have to use so much. It's such a capital intensive business from what I understand to be in real estate. So you have to look at the money coming in, which is more of a good signal. So the money coming in that's being paid out is an AFFO, and it's at 74%. They say below 75. So it's right at their threshold. And we can see a lot of it. They've been in the mid 80s, 90%. But yeah, let me see what they're doing with the shares. Now, with REITs, and I just want to say this, don't always be scared away by growing shares, because what in theory they're supposed to do is they're supposed to have more money coming in. And companies, they only get more money when they create new shares to distribute out and basically have people buy them. Because once a company sells those shares on the market, then there's no more money coming into them. They don't get another penny from that. So when we buy and sell and it goes up, they're not getting anything. I guess unless the shares they hold, I don't know. We won't get too deep into it, but the whole theory is that they're issuing more shares to bring in more money. They should be investing that in property, and then that should be bringing in more revenue, more sales, which they have been doing. So the shares outstanding has been going up quite a bit, as has been the total sales has been going up. So 3% return on invested capital. Anyway, interesting. You know, they're debt again. They're a REIT, the debt. They have to have it. So yeah, 45. Stag is interesting. I'll look up the other one real quick. UGI, I think they were a really safe company. Yeah, 99. So won't get too big into them, but there you go. So UGI gets a 99. So if you were going to go based on Simply Safe Dividends, UGI is a little bit more safe. Oh boy, look at SNC. So again, thank you, Stephen. That was my first ever super chat. Man, that's beautiful. Thank you. I'll drink to that again. So I want to keep these around an hour. If anybody wants me to just do a really quick dividend safety score, check. Why don't I do that so I don't ramble on for 5 minutes about one company? But if you want me to look up, I'll go on really quick. My thoughts on Target. Man, I love Target. I've been buying Target. I bought another share. I wasn't going to do I thought about doing a portfolio update video, but I thought this might be a little more apropos, I guess. Maybe later in the week I'll do one. I don't know. But I've been buying more Target. I think they're fantastic. That 20% raise to me, yeah, they misjudged. They got stuck with a lot of big bulky items, right? Like TVs and patio furniture, things of that nature. So they have an inventory surplus, which is not good. I know that they kind of ripping off the Band-Aid all at once by saying that we're going to slash prices. We're going to try and clear out inventory. We kind of goofed up. We read it wrong. Consumer sentiment shifted where people are spending more on experiences now instead of stuff, where when we were in COVID times and people were flush with cash, they were buying stuff for their houses, comfort, things like that. So they kind of read it wrong. They thought people were going to keep buying stuff. And now people like my family just did. We had a nice vacation into the Ozarks and we spent money on experiences. So they're kind of stuck with a lot of things and they want to liquidate that inventory, which is meaning they said it's going to be worse, I guess, sales, not going to be as high operating margins. Their margins are going to get squeezed for a little bit in the near term, but because they're so well run and management is so confident in the company, they gave us that bombastic, is that a good word, pun intended, for 4th of July weekend, Independence Day weekend. They gave that bombastic 20% dividend hike to say, we got you. We're comfortable in the company. We know where we're going. And as a token of our confidence, we're going to give all the shareholders that are going to stick with us a 20% dividend increase and going to get paid to wait. So I just got paid 20% more to wait. And I'm going to keep acquiring. I'm building up to 10 shares. I think we are at, here, if you want to look. Come on, everybody. Come along to the Simply Safe Dividends machine. I think they're 93, maybe. 90. So they have a very safe dividend, 3% yield, which is above the 5-year average. And here's my shares. Currently have 4 shares. My yield on cost is 2.91%. So I'm down $25 on Target, down 4.1%, getting $17 a year. That's going to keep going up. Honestly, I could see myself adding a share a week. I know European Dividend Growth Investor, he thinks that they could see I'm going to quote him a little bit, paraphrase him maybe. He thinks they could see the $100 a share, 110, somewhere around there. And, if that's the case, man, I don't mind it. I know they had a little bit of a high payout ratio here. 50 years, they just became a dividend king. I mean, check that out. 20-year compound annual growth rate of 14%. Just solid, really solid. And yeah, they were as high as $266 a share in 52-week range. They're down to 139 now. They were as low as 139. Now they're at 142. And I think they went lower than that. I don't think that's right. Free cash flow payout ratio, 76% though. So yeah, that's a little bit high. And that's something to keep your eye on. I'm hoping that starts coming down is what I'm going to watch. And there it is, the free cash flow per share. Been dropping a little bit on Target. I could do this all day, guys. I love it. Shares outstanding, we're at 663 million in 2013. Now we're down to 484 million. And as we've been buying back shares, the total sales have, for the most part, been creeping up. And again, they were helped out a lot by COVID. Just really high return on invested capital, high ROIC, high return on equity, 46%. A little bit low margins. So those margins is why people are selling off, are probably going to start coming down and be low for a little bit in the near term. A little bit of debt. Hopefully they're going to start paying down debt. 60%, that's a little high, but Very nice interest coverage ratio at 18.88. So that right there is Target, and I will keep buying more Target. I like Target, and I don't know. Do you guys shop at Target? Every time I go into a Target, there's always people in there. There's always looks nice. It's cleaner, I guess. Is that weird to say? I think Target is cleaner than Walmart. It's like Target, right? It's a little bit more of a hoity-toity, I guess, of the supermarkets. I like them both. What the heck? I can shop at both. So I like Target, and I'm going to keep buying. Mike, Buffett buys more Oxy, Citi, and CVX. Is there a good buy? Yeah, we talked about some of his buys recently. By the way, welcome to Vegas, Mug. Love Vegas. We took the kids there. SNC, sorry. Maybe laugh. He just got home from Target. Let's say unless. Anyway, Buffett buys more Oxy, Citi, gotta focus, and CVX. Chevron, I'm not so sure about Chevron. I've owned them. I'm going to keep holding them, but God, I think that oil prices are going to be high for a little bit. I don't know when they're going to come back down. I know they're not doing all they can here. I don't know. It's such a touchy subject, right? I know the politicians, they love to trash the oil companies, but then they tax the hell out of them. There's such a cash cow to fund a lot of the political projects and things they want to do. So it's like a necessary evil for a lot of politicians in countries. But until we find a better way, they're going to be with us. Citibank, we covered them. I think they look interesting. They're at a really cheap price. And Occidental Petroleum, if he holds them, we'll have to see if he keeps holding them. Yeah. Oh, I did miss something. Meow. I missed what Meow said. Content on treasury bonds. My opinion, treasury bonds so underrated, even though they're the safest to invest out there. I'm honestly not that familiar with treasury bonds, and I do believe that Ian Lopic, check him out. He did a video on bonds. I don't remember if they were treasury bonds. Maybe some of you know, but so I'm just seeing some of these I missed, guys. Sorry. Yes. I don't know. I'd say check out Ian's channel. He did something on bonds, but I know bonds, their yields are way down too, right? I believe. I think I read a lot, guys. I read a lot. And I think I remember just reading a blurb about treasury bonds. So it's kind of like in the theme of there's no safe place to hide because equities are falling. Bonds are falling. The dollar has been falling. Crypto getting wiped out. So it's like gold still hasn't been popping. It's higher than it has been in the last, 7-8 years, but gold hasn't gotten the message that it should be riding high. So it's like, where are you hiding out? And I think that was something I was reading at. All right, we'll do one more here. I think if we'll look at big lots, I don't know that they're horrible. I once upon a time owned big lots, and let's see, back to the top. BIG. I think Dollar General has been everywhere. So on our trip, we drove from Chicago to Kansas City over to the Ozarks, then Ozarks to Peoria, Illinois, and then Peoria, we took back roads back to Chicago area. And dude, the two things I kept seeing everywhere were Dollar Generals. There was some little podunk towns that we went through, and I swear to God, all they had was a gas station and a Dollar General. So Dollar General and Casey's, which are both publicly traded companies that I have not looked into, and I do mean to look into them. But big lots, only 590 million small cap. What do they give them? Borderline safe 50. We'll just really quick here. They have not grown the dividend. It's been frozen. Okay, well then that's probably why they've had a little bit of, yeah, okay. I sold out of them, I think, in 2019, so before they froze it. And 52-week range, $20. That's interesting. Okay, so as high as 65. Yields 5.88. What? Their forward PE is negative 14.0. Don't remember when I've seen a company with a negative PE. That's because they're free cash. So this is all being paid with debt then. Ay, ay, ay. Yeah, man. Free cash flow per share, negative $12.20. Earnings per share, negative one. Holy cow, you weren't lying, man. Sales growth is just getting worse. Earnings per share growth. Oh my God. Well, they're still buying back shares, which tells me if they're still buying back shares and paying a dividend, but they have negative free cash flow, then the share buybacks and the dividend are being financed with debt. It has to be, right? Free cash flow margin negative. Oh, bucket of yuck. Yeah, see, there it is. Net debt went from 48% to 64%, 64% to 67%. So they are completely, and they're 1160 ICR. Yeah, you weren't lying, man. That's pretty bad. Wow. So I would stay away from Big Lots. Looks like they're having trouble, and I wouldn't be surprised to see them eventually. I don't know, what would they do? Be acquired maybe if they get cheap enough? That was yucky. Thanks for sharing, man. That was a bucket of yuck. Yeah, SNC got home from Target. That's funny, see? Thank you for spending some money at Target if you did, unless you went around there to just walk around and browse, get out of the heat, wherever you're from. Yeah, Treasury bond. Yeah, thanks, Steven. Or just, again, I think Ian did something on bonds that he took some flack for. ET and FANG quite a bit. ET for natural gas, FANG for oil. Nice, Caitlin. FANG, isn't that Diamondback Energy, I think? Energy Transfer, I do have. I have Energy Transfer, and yeah, I'm not that familiar with Diamondback, although I do believe that is the ticker for Diamondback. Here we go. See, that's great. Series 1 bonds are high. What I know, there's Treasury bonds, or is it the T-bills that I think you can buy up to $10,000 worth a year, maybe? I don't know. I heard something about those. There you go. Blue collar. Hey, Bill, what is up, man? Thank you for checking in, popping on. Dollar General's all over in Michigan, including up north in the small towns. Huh. Yeah, that's really interesting. You know what? Let's look. All right, I lied. Let me pop on old. Come on, everybody. Let's look at Dollar General. I don't remember their auto. DG. There it is. 64. That yield. So this is interesting. The dividend yield is 0.89%, so under 1%. And these are companies that I've always turned a blind eye toward because I want those bigger yields. But check out their dividend growth. 31% was their last. So this is kind of interesting to think about, buying these companies that have a really low current yield, but they give such big increases, and your yield on cost is just going to skyrocket. 55 billion large cap. Let's see. Let me see if it'll tell me how many stores. Holy crikey. As of February 25th, 2022, it operated 18,190 stores in 47 states in the U.S. I believe it, man. I just saw them. I lost count of how many Dollar Generals I saw. 18,000 stores. Man. Recession sales up 3.5%. So it looked like they had a dividend that they started slowly cutting, and they eliminated it maybe during the Great Recession, but started paying again around 2016. But yeah, 20-year CAGR still of 17%. And I'm going to bet they have a low free cash flow payout ratio. $2.20 a share for Dollar General. That yield perfectly in line with the 5-year average. The PE is about in line. Oh, no kidding, man. They're holding up. Look at that. The 52-week range was as high as 259. They're only at 246, so just a little bit off. PE, not crazy, 20.8. And yeah, free cash flow payout ratio, 27%. They're going to be able to keep increasing that forever. Well, not forever. You know what I mean. Free cash flow per share is dipped. Again, kind of like who are we looking at? that they were at target. They were just had a really big influx of cash in 21 and then dropping down back, kind of reverting to the mean. That's all that I see that as. Sales growth, 3%, starting to get better. Yeah, just a lot of these retailers with the ginormous sales growth in 2021. And again, yeah, perfect. I love to see this. Shares outstanding, 334, down to 233 million. And Dollar General's total sales just up and to the right. Return on invested capital could be a little better. Return on equity is good. Their debt, a little bit of debt though, 71%. It's been increasing. So I'd like to see that debt start to come down. And they have a good amount of interest coverage ratio, $19.52. So Dollar General looks good, and I'd like to see them more back at the, sorry, don't pass out if you're watching this. So they were as low as $187. So, man, if they can get under $200 a share, that might be a good spot to consider Dollar General. So, all righty, let me catch up on these. You guys got to go. Yeah, I got to go too. Look at me jabber-jawing 1 hour, 16 minutes. Are you kidding me? 31% increase isn't a lot. You know what, Rick? That is a very, very fair point. But the hopes is that they're going to do like 31%. And then next year it'll be, I don't know, 25% and maybe even 14%. And then a 20%. Like those are the ones you want to start adding up. But I hear you. And it's because of that I still have such a problem buying these companies when they're at such a low starting yield, which is like Apple, right? I have a problem just starting that position with Apple. Anyway, everybody, dude, again, I just so thankful for that super chat. That was really cool and unexpected. And yeah, I think that's going to do it, everybody. Thanks for hanging on. And if you're watching this on the repeat, what the hell's the matter with you? Why are you still this far? All right, everybody. Anybody have any last words? Anything you want to say to close out the live stream? Pop it on right now. Let me hear you. Let me see what you got to say. Because, I don't know. Oh, want to go to dapperdividends.com. I got the portfolios, although I think I need to update it. I've been on vacation. So I'll give it another second here for the 16 of you that are still hanging on, holding on. If you want to say something, say it. If not, we'll call it a day. So I guess not. I do. Yep, there it is. The last one. Caitlin says, have a good 4th. I will have a good 4th. Happy Independence Day, everybody. Fantastic one to end it on. I've been Russ. This has been my Dapper Dividends channel. Wait, no, one more. Rick, I'll squeeze you in, Rick. Have a great Independence Day. Okay, now we're going to end it. I will have a great Independence Day. Thank you, Rick. Thank you once again for tuning in.